Plenty of eyes are on the Federal Reserve today as Chair Jerome Powell gets ready to release the agency's latest interest rate decision. Now, this comes as the Federal Open Market Committee wraps up its two-day meeting amid mounting signs of economic growth.
It's astonishing how most people believe it's entirely normal for the Federal Reserve to set interest rates. This practice is essentially a financial form of rent control, which many economists recognize as a losing strategy because it distorts and damages the real estate market. Interest rates are effectively the price borrowers pay to rent money. Since the 2008 to 2009 financial crisis, the Fed and other central banks have been distorting and damaging credit markets, hindering economic growth. Initially, the Fed provided temporary liquidity to prevent a financial meltdown, but instead of scaling back once the crisis subsided, it continued buying government bonds and mortgage packages to suppress both short-term and long-term interest rates. The Fed's securities holdings skyrocketed from about $800 billion before the crisis to over $4 trillion, ushering in an era of zero interest rates and unprecedentedly low borrowing costs. This led to a borrowing frenzy by governments and parts of the private sector, while paradoxically making it harder for small businesses to obtain credit. The COVID-19 pandemic exacerbated this trend, prompting even more Fed bond purchases. As a result, the Federal Reserve's prolonged intervention has created a distorted economic landscape. The excessive buying of bonds and other securities has not only kept interest rates artificially low, but has also led to significant imbalances in the market. Large corporations and governments have benefited from the cheap borrowing costs, accumulating massive amounts of debt. However, small businesses and individual borrowers often struggle to access credit on favorable terms. The Fed's policies have also contributed to asset bubbles in various sectors, including real estate and the stock market. Investors searching for higher returns in a low interest rate environment have poured money into these assets, driving up prices and increasing volatility. This has created a precarious situation where any shift in interest rates or market sentiment could lead to sharp corrections in financial instability. The prolonged period of low interest rates has encouraged risk-taking and speculative behavior among investors. The search for yield has led to the growth of highly leveraged investments and financial products, which could pose significant risks to the stability of the financial system. While the Federal Reserve's actions during the financial crisis may have been necessary to prevent an economic collapse, the continued intervention and suppression of interest rates have led to significant market distortions and long-term economic challenges. It is essential for policymakers to recognize these issues and consider strategies to gradually normalize monetary policy, ensuring a more sustainable and balanced economic environment. Today, the Federal Reserve's holdings exceed $7 trillion, down from the COVID peak, but still excessively high. This substantial balance has been a major factor contributing to the current inflation. Global debt now stands at nearly 3 times the global GDP, and economic growth in most countries has been lackluster since the 2008 to 2009 crisis. This raises the crucial question: why is the Fed still trying to control interest rates given its poor track record? The standard explanation is to combat inflation by slowing down the economy. However, a robust economy does not cause monetary inflation. Reducing the value of the currency does, typically by increasing its supply. Historically, central banks would raise short-term interest rates solely to maintain the currency's value. Economic activity was influenced by government fiscal and regulatory policies. This approach began to shift significantly in the early 1970s when President Nixon intentionally devalued the dollar to stimulate the economy before the 1972 election. Until 2008, the Federal Reserve focused on controlling bank reserves to influence economic activity. Since then, interest rate manipulation has become its primary tool. particularly the rates it pays on bank reserves and the money it borrows from money market funds, a practice not used before the financial crisis. The extensive influence of the Federal Reserve over the economy, particularly through its manipulation of interest rates, has significant implications. The central bank's current approach often involves setting the rates paid on bank reserves and borrowing from money market funds, a strategy that emerged post-2008. This has shifted the focus from merely controlling bank reserves to directly influencing the broader financial system. This method has not been without its consequences. By keeping interest rates artificially low for extended periods, the Fed has encouraged excessive borrowing and risk-taking, contributing to asset bubbles and financial instability. The resulting economic landscape is marked by inflated asset prices and heightened volatility, making the financial system more vulnerable to shocks. We can only hope that the next president will thoroughly review the Fed's operations and the power it now holds to prevent further and potentially greater harm. Now, if you like this video, check out this next video right here.